Hello, this is Dr. Bhushan Sharma. Welcome to this video. Now, today we are going to see how butterfly, condor and debit spreads work in handling Nifty. So what option buyers can do? If 10 days EMA is sloping up and Nifty is above it, we can create a bull call butterfly when VIX is below 20 and create a bull call debit spread if VIX is above 20. Uh, of course, though I say above 20, ideally whenever VIX is above 25, probability is very less that the 10 days EMA is sloping up. More often than not, it will be sloping down. So if 10 days EMA is sloping down and Nifty is below it, create a bear put butterfly when VIX is below 20. Create a bear put debit spread if VIX is above 20. When we talk of bull call butterfly or bull put, bear put butterfly, how do you create it? Buy at the money option, buy another option of same type about say 2 to 2.5% out of the money, and sell two lots of same type of option 1 to 1.5% out of the money. This strategy works better with weekly expiries, or on the expiry day you can narrow down the margins. Instead of 2.5%, you can just narrow it down a little. Okay, ideally these should have their strike prices equally away from each other, so that hedges your positions perfectly, right? You have to hold it till expiry, because it's on the expiry day you will get maximum profit in this if it expires somewhere near the strike price of sold options. For puts, you have to do the opposite. Buy at the money put, buy another put 2 to 2.5% away, lower strike price, and sell two lots at a middle strike price. For a bull call debit spread or a bear put debit spread, what do we do? Bull call debit spread, we buy at the money call option and sell 1.5 to 2% out of the money call option for a weekly expiry. For put, we buy at the money put option and we sell 1.5 to 2 month OTM put option for same expiry. So strike prices are different, expiries are same. So what are the success rates? Now see, butterfly actually gives very good risk reward ratio of 1:3, 1:4, sometimes even more. Of course, depends how much time is left to expire. If it is just 1 or 2 days, then risk reward ratio may be slightly low. But butterflies other way around give 1:3 to 1:4 risk reward ratio. And if you are doing it correctly, 60-65% success rate. So together this combination is fantastic. So if somebody creates a butterfly every day, either sometimes when Nifty is flat, you may create long iron butterfly instead of bull call butterfly or bear put butterfly. So you are not expecting Nifty to move up or down. If you are expecting it to move slowly up, bull call butterfly. You are expecting it to go slightly down, bear put butterfly. If you are expecting it to remain range bound, it's long iron butterfly, which work the best. When if India VIX is less than 20, then these work better. But if India VIX is greater than 20, the success rate starts dropping, because Nifty may simply go out of that range and then you will not make money, or you may lose money even if it goes out of this range close to expiry. So they are not recommended when India VIX approaches 20 or crosses 20. All right. Other way around, you can do it. And majority of the times, India VIX is less than 18 if you check. So whenever it is between 13 to 18, which is most common, that time butterflies work very well. So for Nifty, I would recommend a butterfly than condor. Basically, Nifty is cash settled. That is the advantage. Uh, so for Nifty, I will recommend a butterfly and not a condor, because profit margin for butterfly is better than that of condor. You will naturally ask me about what is the break-even point. Yes, one thing is there. Butterflies usually have break-even points closer to the middle price than the condors, but the profit margins are much higher. So if you consider that, maybe your profit will increase by 50, 60, 70 points, but your risk break-even points may come closer by maybe 8 or 10 points or 15 points. Then it makes sense that you create a butterfly instead of a condor, because your profitability increases. But if we talk of stock options, now I know that this course is about Nifty, but about stock options, there is delivery. And delivery based contracts, the problem with butterfly is you're sold, suppose you have done a long iron butterfly, you're sold call, you're sold put, and you're bought out of the money call and put to hedge it. The problem is you have to either give delivery or take delivery even if slightly the expiry comes away from the middle price, strike price for which you have sold. And in the last 30 minutes, if there is a move, we have already seen what is the closing price, and settlement is always done with respect to closing price. So in last 30 minutes, if there is a move, you are always confused whether that expiry will be below the mean strike price or above the mean strike price. I'm going to take the delivery or give the delivery. That makes use of butterfly a little difficult in delivery based options. So there I would recommend use of condors, which is better than butterfly for delivery based options. Okay, more we are going to learn in the next video.